Welcome to the Deep Dive. Today we're tackling something you might hear about in those very exclusive meetings. You know the ones.
The ones in the fancy offices, maybe Raffles Place way up high, where they talk about alternative assets.
Exactly. We're cutting through the jargon around private credit and private equity. These things pitched as offering high returns, maybe low volatility.
Yeah, the promise is definitely appealing. So imagine you're there. Your relationship manager slides a couple of those, thick brochures across the desk.
Option one sounds safe, stable, high yields, away from the crazy stock market. That's private credit, or PC.
And option two, well, that's the moonshot, right? Get in on the next grab before the IPO. Huge potential.
That's private equity, PE. Sounds amazing.
Both sound great on paper, especially if you're maybe a bit frustrated with public market returns.
But hang on, before you sign up to lock your money away for, 5, 7, 10 years, you really need to understand what you're actually buying.
That's our mission today. Let's demystify these things, because the key question is, are you signing up to be the cautious banker, or are you aiming to be the, let's say, speculative business owner?
Because those are fundamentally different roles with totally different risks involved.
Absolutely. Understanding that difference debt versus equity in the private world is, well, it's everything.
Okay, let's break it down. I think an analogy helps here. How about a restaurant?
Perfect. Let's start with private credit. Think of yourself as the banker for this new restaurant.
Okay, I'm the banker.
Right. So fundamentally, PC is a loan. It's like a custom-made private bond. You lend the restaurant, say, $1 million to get started. Buy the ovens, chairs, all that.
And how do I make money?
Predictable interest payments. Let's say it's 10% a year. You get your $100,000 annually. Simple as that. Doesn't matter if the food's average or if it suddenly gets 3 Michelin stars.
My return is fixed.
Fixed, stable income. And crucially, think about the risk hierarchy. If that restaurant unfortunately goes bankrupt, you, as the creditor, have the first legal claim on the assets, the ovens, the property lease, whatever's left. You get paid back before the owners see a cent.
So I'm senior. I have priority. That sounds safer.
It generally is safer from a capital preservation perspective, but there's a catch, isn't there?
Yeah, the upside. It's capped, right? I just get my interest, my 10%, and eventually my $1 million back. I don't get rich if the restaurant becomes, I don't know, the next big global chain.
Exactly. You trade that massive potential upside for predictability and hopefully stability. Private credit returns, they tend to be less volatile than PE and often better than traditional bonds.
Okay. Anything else attractive about PC right now?
Well, yeah. A lot of these private loans have floating interest rates. So when overall market rates go up, like they have been.
My interest payments go up too.
Correct. It acts as a kind of hedge against rising rates, which is pretty appealing to income investors right now.
Okay, that makes sense for the cautious banker profile. Now, flip the coin, private equity being the business owner.
Right. Here, you're not lending money. You're buying an actual ownership stake. You are the restaurant owner or part owner.
So maybe I pool my money with a PE fund and they buy the restaurant outright.
Precisely. And the PE firm's job isn't just to sit back. They actively try to increase the restaurant's value.
Yeah.
Maybe restructuring, cutting costs, improving the menu, expanding. They're hands-on operators.
And the return potential.
Potentially huge, uncapped. If that PE firm transforms the restaurant, makes it incredibly successful, and then sells it for, say, 5 or 10 times what they paid.
I share in that massive profit. That's the dream scenario.
That's the dream. That's how you get those, multi-bagger returns people talk about. And it's a big but.
Risk must be higher.
Completely reversed. As the owner, the shareholder, you are dead last in line if the restaurant goes bust.
So if it fails?
You could lose everything, your entire investment. The downside is potentially 100%. The bankers, the suppliers, everyone else gets paid before you get anything back, if there's anything left at all.
Quick clarification on PE, though. Are we talking tiny startups here, like venture capital?
Generally, no. PE typically focuses on more mature, established businesses. Maybe taking a public company private, fixing it up, and selling it again later. Venture capital is more the really early stage, high-risk startup game.
Okay, established businesses, but still, I'm last in line if things go wrong.
Got it, right. And that risk profile brings us squarely to the reality check, especially here in Singapore. Who gets offered these products?
Also, always accredited investors, right? The AIs.
Exactly. And the MAS definition, you need either SGD $2 million in net personal assets or $300,000 in annual income. It sounds exclusive.
But it's really just a measure of wealth, isn't it? Not how much you actually understand about complex finance.
That's the critical point. It's a wealth test, not a sophistication test. You could have a retiree Maybe their HDB is fully paid off, lots in CPF, so they technically hit the $2 million net worth mark.
But they might not know the first thing about analyzing the underlying loans in a private credit fund or the turnaround strategy for a PE portfolio company.
Precisely. And these are often the exact people targeted for these high-margin products. The relationship manager highlights the attractive yield, the exclusivity,
The glosses over the real risks hidden beneath, like what's the biggest one?
illiquidity.
Yeah,
It's huge. These are private investments. You can't just sell them on an exchange tomorrow if you need the cash.
so my money's locked up.
Absolutely locked up, often for 5, 7, even 10 years or more. There's usually no easy way to get your principal back before the fund term ends. Think about that. An emergency comes up, tough luck.
Wow, 10 years is a long time to have capital tied up with no flexibility. That's a massive commitment.
It really is. And then there are the fees. They can be substantial.
The famous 2 and 20.
Often, yes. A 1% or 2% annual management fee just for managing the fund, plus potentially 20% of any profits they generate above a certain hurdle. These fees eat directly into your net returns.
Okay, illiquidity, high fees, what else?
Complexity and opacity. It's hard for an individual investor to really dig into the details of the private companies being invested in or lent to. You're relying heavily on the fund manager's skill and diligence.
Which brings us back to private credit. If it's complex, illiquid, and you're lending to potentially riskier companies, why is it booming right now? Why are funds pouring capital into it?
That's a great question. There's been a major structural shift. Back in the mid-90s, banks handled most of the lending for big buyouts, maybe 70%.
Okay.
By 2020, that number was down below 15%. Banks pulled back, partly due to regulation after the financial crisis.
And private credit funds stepped into that gap.
Aggressively, they saw an opportunity. But here's the kicker. They often lend to companies that banks might now deem too risky, and sometimes with fewer protections for the lender, weaker covenants, as they call them.
Ah, so the high yield isn't just magic. It's partly compensation for taking on more risk, lending to potentially weaker borrowers with fewer safety nets than a traditional bank loan might have had.
That's a big part of the story, yes. Rising interest rates have definitely boosted the potential returns, too. You hear numbers like 12% cash yield, maybe 14 to 15% total return potential. That looks really attractive, sometimes even rivaling expected PE returns.
But
But remember, private credit lives and dies by avoiding losses. Unlike PE, you don't have those one or two massive winners that can make up for several investments going bad. In PC, if a few loans default, that stable high yield can disappear very quickly. Loss avoidance is rule number one.
And we've seen in Singapore how complex, high-yielding things can go wrong for retail investors, even if they are technically accredited. The high-flux situation comes to mind.
Exactly. While high-flex perpetual securities weren't private credit or equity, it's a powerful local example. A complex product pitched aggressively on its yield, not fully understood by many investors, leading to devastating losses. The parallels in complexity and sales tactics are definitely there.
Okay, so summing this up for someone listening, maybe someone who qualifies as an AI and is being pitched these things, what's the bottom line?
Our view is pretty clear on this. We have a foundational principle.
Yes, and let's
Yeah.
be direct. For almost every Singaporean investor, your financial security is built on a bedrock. That's your CPF, your home equity, maybe some solid, boring government bonds or broad market ETFs like one tracking the STI.
That's your core. That needs to be rock solid first. Private investments, if you even consider them, should be treated like a small speculative satellite dish on the roof, not part of the foundation.
Maybe 5%, 10% of a very large, very diversified portfolio, and only if you really understand the risks and can afford to lose that capital. It's definitely not a core holding for the average person.
Absolutely not. But if you are going to engage, if your RM is persistent, you need to go in armed with very specific questions. Don't be shy.
Okay, let's say you're tempted by private credit playing the banker. What do you ask?
Demand specifics. What is the actual historical default rate for this fund's specific portfolio? You need that number. And show me the liquidity terms in writing. What's the lockup? Are there limits on getting money out, like only 5% per quarter? What's the notice period?
Get the exit strategy crystal clear before you go in.
Precisely. Now, if you're tempted by private equity playing the speculative business owner.
Fees, right. Got to ask about fees.
Definitely. Can I see the full fee breakdown? Management fees, admin fees, performance fees, any other hidden costs. Remember, high commissions often drive the sale of these products.
And given the risk of total loss.
Ask the tough question. How many investments in your previous funds have actually gone to zero? Their answer, or how they answer, tells you a lot about their risk appetite and track record.
Okay. But what if all this sounds too complicated, too locked up, too risky? Are there simpler ways to get similar kinds of exposure?
Yes, thankfully, there are safer, more transparent, publicly traded alternatives.
Like what? For income, maybe, instead of private credit?
You could look at REITs listed right here on the SGX, Singapore Real Estate Investment Trusts. They offer income, exposure to property, but they trade like stocks, so you have liquidity.
Okay, REITs for income. What about getting some exposure to that private lending space, but without the lockup?
There are things called business development companies, or BDCs, mostly listed in the US. They lend to mid-sized companies, kind of like private credit funds, but their shares trade publicly.
So you get liquidity.
You get liquidity, which is a huge plus. But be warned, they still carry risks. The underlying loans can still default, and they can be complex structures themselves, so still need to do homework.
And for just pure stability, if you just want safe income.
It's hard to beat high-quality Singapore government bonds, SGS bonds, transparent, backed by a strong government, predictable income, much simpler and safer than private credit.
Right. Stick to what you understand.
So let's bring it back to that meeting room, that pitch.
The core analogy. Next time someone offers you a private investment,
Ask yourself, am I being asked to be the careful banker, content with a steady return? Or am I being asked to be the risk-taking business owner, shooting for the moon, but risking it all?
and critically, am I truly prepared financially and emotionally for what happens if that metaphorical restaurant burns down?
Because here's a fundamental truth in finance. If you don't understand exactly how someone else is making money from a product,
Then chances are you're the one they're making money from.
yeah,
Be smart, stay skeptical, and when in doubt, stick with the simple, liquid, transparent investments you genuinely understand.